Howdy, Jacob here. Today we're looking at FTI Consulting in the professional services industry, 6.9 billion market cap, 6.5 billion enterprise value. Their return on invested capital recently pretty solid, 10 to 12%, likely above their weighted average cost of capital, meaning that they're creating business. Operating margin increased from 10 years ago, but down a little bit from their peak in 2019. Gross margin down a little bit, and revenue is almost double from 10 years ago. So you're looking at pretty significant revenue growth. Gross margin, okay. Operating margin, double digits, so solid. And then return on invested capital, double digits. So again, solid. With no money going to R&D, majority of their expenses are cost of goods sold. Balance sheet shows 328 million cash-like products with zero short-term debt and zero long-term debt. All right. So their only capital leases are their interest-bearing expenses, and they have a good amount of cash on hand to be able to cover any sort of debt that can come up to them. Good increase is shareholders' equity. Cash flow statement shows very solid production of free cash flow, much higher cash from operations, a little bit higher capex, but nowhere near as much as cash from operations. So their free cash flow is growing quite a bit, with a lot of their money recently going to debt reduction, but historically kind of split between share repurchases and acquisitions. And so, I think that's enough to make some of my own assumptions here. So for revenue growth, I'm looking at the professional services industry. It looks like they provide business advisory services to manage change, mitigate risk, and resolve disputes worldwide through corporate finance, restructuring, forensic and litigation, consulting, economic consulting, tech, and stratcom. All right, interesting. So I would say that I'm probably looking at something around 5-6%. They spend some money towards acquisitions. Let's push towards the 6% here, with margins historically ranging from pretty close to that 8% range. So let's do 8 and 9%. Share change. They haven't bought as many shares back recently, but even if it's just 80 million, which is of their 5-year average, maybe 25, 33% or so, they can buy back about 1%. So that's splitting between mostly acquisitions and share repurchases. And then let's do pretty much market average here. I do think they have a pretty good return on invested capital, but margins aren't great. I'm not seeing everything that's really exploding at me. I think that's good growth, but I think at the end of 7 years, you're probably looking at close to market growth there. So for me right now, it still needs to fall quite a bit before it gets to return that I think is going to be very appropriate and very significant for it. And so for now, I'm just going to be reviewing other companies in the meantime. Hope you enjoy the video and have a great rest of your day.